Hi everyone, welcome back to Tax Tutoring and Training. My name's Hannah, and in today's lesson, we're going to be going over taking the credit for child and dependent care expenses. Now, this is the first video in our credits lessons, which will be linked in a playlist on my channel. And in these next few lessons, we're going to be going over all the different types of credits that you're eligible to claim on a tax return and how you would be eligible to claim them. So this is good for any taxpayers who are wondering if they qualify for a credit, or if you are trying to be certified to be a volunteer income tax preparer. Then this lesson is great to learn how to interview a client to see if they qualify for the credit for child and dependent care expenses. As always, the guided notes will be linked in the description down below. Thank you guys so much for watching, and stay engaged, and hope you enjoy the lesson. Okay, so first I want to start off by going into what exactly is a credit. And a credit is basically an amount that you can take as a tax reduction, meaning that the total amount of tax you owe will be reduced by a credit. There are two types of credits, which is a non-refundable credit and a refundable credit. A non-refundable credit is a dollar-for-dollar reduction of the tax liability. This can only reduce the tax liability to zero. This would mean if you have this expense and it costs $300 and you had a tax and you had to pay $600 in taxes, then only $300 can be subtracted from that 600 because it's a non-refundable credit. If you had $700 in tax credit and you only had to pay $600, then it would only reduce your tax liability to zero if it was a non-refundable credit. A refundable credit, however, can reduce the tax liability over zero and result in a refund. And a refund is basically the IRS pays you money back. So an example of this would be if someone had a tax liability of $100 before credits, a non-refundable credit of $150 can reduce the liability to zero but not produce a refund. Whereas a refundable credit of $150 could zero out the tax liability and produce a refund of up to $50, meaning the taxpayer would get $50 back, which is pretty cool. The Child and Dependent Care Credit, which is what we're going to be talking about in this lesson, is a non-refundable credit, and it's claimed by those who work, look for work, or pay someone to take care of their qualifying person, and through that process they incur such and such expenses. A qualifying person counts as a qualifying child under age 13. If you don't know what a qualifying child is, go see my lesson on dependents. I'll link it in the video. That will give you some aspect of what a qualifying child is. But in order to be a qualifying person for the credit, it must be a qualifying child under age 13, a spouse who is incapable of self-care, or a dependent who is incapable of self-care. Okay. So the credit ranges from 20 to 30% of the taxpayer's expenses. And this percentage is based on the earned income and AGI of the taxpayer. The income tax return software that we use is called TaxSlayer, and that software will automatically calculate how much of those expenses can be taken for the credit based on the taxpayer's entered earned income and AGI. The credit cannot be more than the amount of taxable income because it's a non-refundable credit. And the credit can only reduce, and thus the credit can only reduce the taxpayer's individual tax to zero. Now, what about employer-dependent care expenses? So sometimes a taxpayer will be part of an employer program where they will receive benefits for childcare from their employers. These might also be called flexible spending accounts or reimbursement accounts. And taxpayers will be able to exclude these benefits from their income, not take the credit, because it's different. It's not like the taxpayer is actually paying those expenses since it's coming from a flexible spending account. So it will be deducted on income. And if you want to learn more about those deductions, you can go see our adjustments to income lesson or our itemized deduction lesson, which is also linked on my playlist on my channel. But taxpayers will be able to exclude these benefits from their income as long as they are listed on the form W-2 and box 10. They will not count towards the credit. Okay, so in order to be eligible to take the credit, the taxpayer must pass 5 tests. And the 5 tests are the qualifying person test, the earned income test, the work-related expense test, the joint return test, and the provider identification tests. You must pass all 5 in order to take this credit. So now we're going to be going into what exactly those tests are. Well, the first test is the qualifying person test. And this basically means that any expenses incurred that you're trying to take a credit for must be for the care of one or more qualifying people. And we went over this with very briefly, but a qualifying child that is only 13 or under, that is a qualifying person, and only the custodial parent may claim for the child. Now, you might be wondering, what is a custodial parent? That's in the situation of a divorce where the kids sorry, where the kids might be split between parents. The custodial parent is the parent who had the kids for the most nights. If the custodial parent does not want to be the custodial parent and wants to sign over custodialship to the other parent, they can only do so if the other parent's AGI is higher. And sorry. And then the next section or standard for being a qualifying person is a dependent or possible dependent who is physically or mentally incapable of self-care. Now, a possible dependent is someone who could be a dependent if they passed all the other dependent tests except for the gross income, joint return, or dependence test. And the last person who could qualify for the dependent care expenses credit are expenses for spouse to help spouses who are unable to care for themselves and live with a taxpayer for more than half the tax year. Okay, the next test, the earned income test. And this test basically says that the taxpayer and their spouse, if they're married filing jointly, must both have earned income during the year in order to claim this credit. The spouse is treated as having earned income for any month that the spouse is physically or mentally incapable of self-care or is a full-time student. So sometimes you'll have the case where one spouse is working and the other spouse might be physically or mentally incapable. So they might be mentally disabled or physically disabled, or they might be as a full-time student. And a full-time student, it's not like all the time you're in school. It's if you're enrolled in an accredited post-secondary education. So basically above high school education. This could include trade school, college, etc. In this case, the spouse's income, if they are either mentally incapable of self-care or a full-time student, their income is considered to be $250 a month. If there's one qualifying person in the household, or $500 per month if there are 2 or more qualifying people. And this income will go into factoring if they take 20% or 35% of their expenses to qualify to go towards the credit. If both spouses are full-time students or not able to care for themselves, only one of them can take the 250-500 rule. And in that case, the other one would not have earned income, meaning they wouldn't qualify. Any of their expenses wouldn't qualify for this credit. Okay, the next test we're going to be talking about is the work-related expense test. And some expenses that are only qualified expenses will be able to count for this. And qualified expenses allow the taxpayer and spouse to or if they're married filing jointly, to work or look for work and are for a qualifying person's care and to provide for that person's well-being and protection. So we went over what a qualifying person's care is, what a qualifying person is, and now we're saying that only the expenses for the care of that person while the taxpayer is working or looking for work are able to count towards the credit. Married taxpayers both must work and must be looking for work, and that kind of makes sense because in the earned income test, we learned that both taxpayers must have earned income, and you kind of have to work to have earned income. And you kind of have to work to have work-related expenses. So the limit on work-related expenses for the credit, though, is $3,000 for one qualifying person and $6,000 for 2 or more. The IRS doesn't want you taking mass amounts of credits mass amounts of money off your tax return. So there is a limit on how much the credit can be used for, and that's $3,000 if you have one qualifying person in your home and $6,000 if you have two or more qualifying people. Another rule to know: if a child turns 13 during the year, only the expenses occurred when the child was under 13 count. Okay. Expenses that don't count. These include expenses such as amounts paid for food, clothing, education, or entertainment. These are often confused with expenses such as education expenses. This could be for like a private school. If you're putting your child in private school, it doesn't count as a work-related expense while you go to work. If you put your child in an overnight camp and you pay for that, it's not counted as a work-related expense. Neither is transportation that's not provided by the care provider. So if you're trying to claim the credit for expenses like gas money as you're driving your kid to daycare, that also doesn't count. Okay. Payments to a relative that is not another dependent of the taxpayer are able to be claimed as a qualified expense. So I am 17 years old. Sometimes I babysit my younger siblings. And in this case, my parents would not be able to pay me to babysit them and then claim that payment as a qualified expense, because I already am claimed as a dependent on their tax return. Household employment taxes. This is if you have someone in your home, like a babysitter, taking care of your qualifying dependents, and this is a qualified expense if used for the right purposes, meaning the parents are at work and they need somebody to watch their kid. Okay, the joint return test. So married couples who want to take the credit must file a joint return. So this means you can't be married filing separately and be eligible for the credit. A taxpayer whose spouse died during the year and is not remarried must file a joint return in order to claim the credit. And in this case, they may or may not elect to include the earned income of the deceased in their calculation to dictate whether they get 20% or 35%, between 20 to 35% of those expenses included as a credit. Okay, and our last test that we're going to be going over today is our provider identification test. And in this test, it basically means that taxpayers must provide the name, address, and taxpayer identification number of the person or organization who provided the care for the child or dependent. This is basically a documentation test, meaning you're not just making up a random organization that's caring for your child. If the provider is an organization like a daycare, it is the employer identification number that will normally list all this information and that you will input into your tax return to take the credit. If the care provider is an individual, the TIN is the same as their social security number. If they can show proof of due diligence, some volunteer income tax assistance sites will allow the credit to go through, but even if they don't have all the numbers, but that's up to site discretion. So if you are a taxpayer looking to seek help with a VITA site, make sure you have all your documentation in order to claim the child independent care credit. Okay, so we kind of went over this before, but just to sum up, how to determine the amount of the credit is you multiply the work-related expenses after you apply the $3,000 and $6,000 limits by the percentage, which is 20 to 35%. And that is the amount that you can take as a subtraction from your total tax amount. If a qualifying person has no expenses and a second qualifying person has expenses that exceed $3,000, list the first person as $0 for expenses and then the actual amount for the second, so they can kind of bleed over. And the taxpayer will also calculate the percentage TaxSlayer, which is our software, will calculate the percentage between 20 to 30% of your dependent care expenses that you can claim as a credit based on the taxpayer AGI and earned income. And this information will all be found on Form 2441. Okay. And to go over in summary, the limits for the credit since it's a non-refundable credit, it's limited to the amount of the taxpayer's earned income. If they're married filing jointly, the smaller of the taxpayer or spouse's earned income for the year, that's what the credit is limited to. And then we also have our dollar limit on the amount of expenses taken. It can't be over $3,000 for one qualifying person or $6,000 for two or more. And we have this example here. Millie has 3 qualifying children. She spent $10,000 on work-related dependent care expenses. 4,800 of that came from an employer plan. When Millie figures her credit, her work expenses will be limited to 1,200, which is how much she can subtract from her total tax having to be paid to the IRS as her dependent care credit. Because 4,800 of that came from an employer plan, that will go on her income statement, not necessarily that will go on her income as a deduction, not necessarily not for the income tax credit. Not the income tax credit, the dependent care credit. All right, guys, that's all I have for you today. Thank you guys for listening, and have a great day. See ya.